Hello, my name is Randall Neighbor. I'm a financial advisor, and I have a number of clients who wanted to buy individual stocks on their own and asked me for some tips. I've been buying individual stocks for a good 10 years now, and I thought I'd take you through my process, how I decide what to buy, when to buy it, how to buy it, etc. So let's jump into this. So understand that I'm a financial advisor, fiduciary advisor that works for a registered investment advisory firm, and nothing in this presentation should be considered investment advice, and it's just informational. Okay, so let's jump into it here. First thing we have to do is build a good, strong foundation for investing and understand the difference between investing and anything else you might be thinking about, so you know you're doing the right thing and you're not building your house on sand, as the Bible says. So the first thing is why are you investing? So set some realistic expectations for yourself and write down your investment goals. Why are you investing? Are you investing to learn more about stock markets? Are you investing to make money to buy a new car or build a home one day, or you want to leave a legacy for your children? Or is it just a hobby? Sometimes you have to revisit these when you get all emotional and decide to do something with your investments, and you have to keep in mind, why am I investing in the first place? Um, Investing is well suited for long-term wealth building, not short-term make a lot of money in a month or a week or a day. And that's really the definition of investing, is having a long-term mentality. You also have got to embrace a constant learning mindset. You're going to learn so much right up front, but then you can keep learning, and you will keep learning. I've been a financial advisor for 15 years now, and buying in individual stocks for as long or longer, and got serious about it about 10 years ago. But I'm always learning. Every day I learn something new about stocks, company profiles, and uh, financials, their performance, etc. You also have got, if you know why you're investing, you won't bail out when markets are bad, and you'll stay the course, because markets are going to go up and down and get good and bad, and there are outside forces that drag down your perfectly good stock pick, and you've got to know why you're investing and remind yourself, why am I investing? What are my long-term goals? So there's a big difference between investing and trading. Um, Trading is more of a technical thing. You're looking at stock charts and trying to figure out when to buy something and sell something to make a quick buck. Investing is characterized by long-term growth and analyzing the company fundamentals, not just the technicals of their stock movement, but the fundamentals of their company, which is quarterly financial reports, leadership, and forward profitability. There's a significant amount of risk and time commitment involved in trading. People who trade have got to be on it. It's your full-time job to be at your computer looking at things during the business day or the trade day, and it's a we it's not very successful. I've known a lot of people who day trade, week trade, month trade, and we have a little joke. How do you get $1 million day trading? You start with 2 million, so you have something left after you've lost half your money. So that's kind of what I think about trading versus investing. If you're here to learn how to trade, you're in the wrong place. Stop the video. It's not worth your time. If you're here to learn to invest long term, I think I can give you some real help here. So there are moral implications of shareholding for me anyway, and I'd like to think that there are moral implications for you as well. Shareholders don't have a legal liability if a big company does something bad. You're shielded from legal troubles, and you're not implicated in that unless you're on the board of directors or something. And even then, you have a lot of liability waivers. But I do feel you're responsible for moral decisions that go beyond financial gains. So investors really should evaluate a company's products, their environmental and social impacts, and their profit usage from an ethical standpoint. If you, for instance, really hate tobacco because your dad died of lung cancer because he was a chain smoker, and you'd never invest in anything with tobacco in it, any fund that has tobacco you wouldn't buy. Um, I'll won't say the name of a very large tobacco company, which is actually quite profitable. And But if you don't care how much money you don't make by not buying that, then you are definitely an ethical investor in one area anyway. So it's important that you align your values with your investments and your investments with your values. Um, I look very carefully at a number of things. I have friends whose marriages and personal lives have been crippled by pornography, so I don't buy stocks that promote, permit, tolerate pornography. So, some really big names there, large internet companies that I won't buy just because of that, because I've seen it destroy lives. Same thing with gambling for me. I believe life starts at conception, and I won't buy stock in a company that pays for employees to go across state lines to end the birth of an unborn child. And these are my convictions. And you've got to write down your convictions. What would I not invest in, even if they made me a ton of money? What am I just not willing to do? And stick to it. And I think you'll do well with that, and you'll be proud of your investments. I always like to say, if you wouldn't stand before God or even talk to your mom about what you're invested in, what they produce, what they give their profits to, then you probably ought not to be invested in it. So um, I also think by doing this, it spreads the good word of being responsible as an investor and investing in things that are good for people, good for the planet, good for us, and avoiding things that are not good for people. So let's talk about your commitment and your strategy. So first of all, have a long-term commitment to learning a lot up front, being patient, being self-disciplined. Don't pull the trigger and buy something just because you feel like it or you think it's a good idea or your brother told you to buy it at the Thanksgiving table or whatever. But you've got to learn, consistently learn, do your research, know why you're buying it, know what they do, um, and commit to continuous learning. So know this, there are a lot of factors that can move a stock price around that don't have anything to do with the company. But as far as the company goes, the government might add a regulation or a limitation to a company that is doing some really neat environmental things because this particular administration doesn't care about the environment as much as the last administration, et cetera. So you need to constantly be watching that and thinking about it, et cetera. Learning reduces the risk of poor decisions. And the slower you are on that trigger finger or that clicker to buy that stock in your little portfolio, the better you'll be. Learn more, slow down, and don't do things quickly. And constantly learn, why is my stock going up? Why is my stock going down? Why is the company's fundamentals strong or weak? And the goal here is to build a resilient portfolio that can stand the test of time and goes up over time. It probably get beat up at times or do so well you think you're a rock star, but what you want to do is build a resilient portfolio. That comes from long-term learning and commitment to learning. So I would encourage you. This is the first thing that you'll say, oh, Randall, man, I don't want to do this. I want to get started here. It's to paper invest, or what other people might call paper trading, but you're not going to be a trader. You're going to be an investor. But create a watch list and of things you'd like to buy, and just say, I like this company. Write down a piece of paper. You don't even need a computer to do this. Write it down a piece of paper, what their stock is currently trading at, and then start researching them, and then Maintaining a watch list and then watching the investments on with paper investing, just investing on paper for maybe even up to a year is a great idea because you can see what happens when a president says we're going to slap tariffs on everybody, or the EPA comes out and does new requirements for clean water or clean air, et cetera. You can get a good idea of what's going on with it. That way, because if you get invested first and you've got money at risk, any amount of money, even $50, you're going to fret over it. And if it's done with paper investing, you won't be fretting so much because if it goes south, you'll say, wow, glad I didn't invest. If it goes north, you can say, hey, I picked a good one. Just don't be greedy and have fear of missing out there. So, but what this does, paper investing helps you build confidence in a very safe way. So, I want to encourage you to buy and hold, not to trade frequently. Um, you know, uh, a lot of really, really smart long-term investors like Warren Buffett said he never buys anything he intends to sell. I'm the same way. I have bought a number of stocks, and there has to be a very, very compelling reason for me to sell something I've bought. I buy it, I hold it, and I never intend to sell it. So I look for really good quality companies, and then I wait for their stock to get beat up, despite their strong company earnings and forward guidance, and then I buy a few shares. So this minimizes transaction costs if you have them. A lot of the new trading platforms that are online don't charge trade fees, but if they do, this minimizes those. It You've got to hold your stocks through down markets. Most people buy their stocks when there's buzz about them and they're at the top of their current range, and they sell them at the bottom when they're scared, and that is completely the opposite thing to do. You should buy low and sell high, and what you need to make sure you do is focus on quality companies. So here's some investment techniques. First one's called dollar cost averaging. So you find a stock you really like, a company is great, you like what they do, you like what they don't do, their byproducts of their giving or charitable things are in line with your goals and your morals, and you decide you want to buy some, and you wanted to buy, oh, I don't know, $1,000 worth of their stock, and it's trading for $20 a share. Just, buy 10 shares, and then on a dip, when it's had a bad day, and then wait. And so buy a little bit at a time. You might be buying it on the way up if it's growing, but if you buy it on the way down, your average price will be lower. So this is called DCA, and it's a gradual investment strategy. But avoid investing a lump sum all at once if your position is sizable. It also can reduce the price if you buy a little bit, it goes down. You buy a little bit more, it goes down. You buy a little bit more, all the while knowing that the company fundamentals are strong. So there's no reason to be scared that the stock dropped, if because over time, over the next, and I'm not talking about weeks or months, over the next years, that stock price will probably appreciate nicely because the company is a good, strong company. So continue to do your discipline and your research while you're doing dollar cost averaging, and you might decide 6 months in, wow, I'm glad I didn't buy more of that. It wasn't as good as I thought. I've learned new things, and so you can stop yourself from dumping a ton of money into something. There are a lot of long-term benefits to dollar cost averaging, from taxes to discipline, and I want you to embrace dollar cost averaging. So next thing is invest with conviction. Set some clear profit goals. How much profit is enough? Do you want to make 20% on a stock, or 30% on a stock, and then take some profits? But you need to set some goals. If you say, no, I want to make 500% on a stock, chances are you're not gonna. I'm thinking of a couple of big technology stocks that have done that, but that's more of a gambling mentality. You really need to have a realistic goal. The S&P 500 has an average of 8 to 12% a year, depending on how you're calculating it over the life of it. And if you can beat that, fantastic. But a lot of this comes through finding best of breed companies and investing in their stocks for long term, and then looking at how much money you've made in it and trimming it. It'll either become too big as a portfolio holding and you need to sell it off to keep its weighting in your portfolio, or you want to take out what you put in. You put in $100, it's worth $800 now. Sell $100 worth of that stock and get your money out of there. Now you're playing with the house money with the remaining $700. Will you have to pay taxes on it? Yes, probably you have to pay taxes on it. Long-term capital gains. Hopefully you've kept it for a whole year, but that's okay. Poor people don't complain about paying taxes because they don't pay taxes. Um, uh, Investing with conviction and comparing your returns to benchmarks, which is what that particular industry has done, gives you a good idea of whether you've picked the best of breed in that. There's a lot to learn here, and I know you're probably already feeling like you're drinking from a fire hose, but just keep watching this and making notes and learning about benchmarks and how they compare to what you've bought. So the more conviction you have in your investments with buying them and holding them, the more confidence you'll have in investing. And you really need a lot of confidence when markets pull back or tank on you. So, long-term perspective. Long-term perspective. It's like having a child and they're in their terrible twos, and you think one day I will have helped create a very high functioning member of society that is loving and caring and productive, and the terrible twos are worth it, right? So you've got to have a long-term perspective with your stocks. So let's talk about diversification and stock selection. So diversification reduces the risk and enhances your stability in it. What it doesn't do for you is let your portfolio triple in a year or something, though. It really proper diversification actually lowers your ability to, hit a jackpot of some sort. So that's the downside to diversification. But I'm more worried about losing my hard-earned money than I am about making piles of money overnight. So diversification is my friend, and I have a highly diversified single stock portfolio, and I will continue to maintain that. I don't have a lot of stocks in any one industry or sector, but there's a number of them. I would suggest that you pick up 5 stocks that from different market sectors, and there's a few different sectors: information technology, of course, financials, consumer discretionary, which is like retail, communication services, healthcare. By picking a stock in each one of these, you move your money in your investments over a lot of different things and sectors. So that helps. So this is where research comes in. To diversify properly, you've got to research things and use online tools like ChatGPT and say how close, how similar is stock A to stock B? Do they track together? Are they different? Are the companies below these stocks that are issuing these stocks, are they similar or are they dissimilar? How dissimilar are they? And learn that, for instance, in really good times when everything's great, retail is strong because people think they have a lot of money and they go spend a lot of money on retail stuff and travel and restaurants and stuff. When we hit a bad recession, you'll see a lot of money flow into utility companies because you might not go out to dinner, but you're going to pay your electric bill. So there's a lot of just common sense and logic involved in this. So it's good that you've got money in both of those types of things so that you can weather good times and bad times. So let's talk about analysis and market forces. So there's 2 basic kinds of analysis that you need to do. The first one, before you start looking at the stock price and how well it's done or anything, is go look at the fundamentals of the company, their balance sheets, their leadership, their profitability, future financial projections. and to find out what their intrinsic value is. You Google that and learn about it. I don't have time here to explain all these terms, but this is the part that most new investors do not do. They're lazy and they don't understand it. But we have new tools. You can go to ChatGPT and ask them and ask ChatGPT for free. Um, Give me the company financials for company XYZ and their last quarterly call and their financial outlook. And what and also ask Chat GPT what does their leadership look like, and does their leadership have a good track record, and are investors happy with the leadership of the company? These are fundamental things. So before you start looking at the stock chart, which everybody wants to do, go look at the company. Is it a good company? Is it a best of breed in its field? Is it a risky company that is carrying a lot of debt to raise money to grow, or are they doing things the right way? And are they profitable? And are they managing debt well? Then, if the fundamental analysis works, we jump over to technical analysis, which is the stock price. And we're focusing on price patterns, trading volume. Is it heavily traded or lightly traded? If it's lightly traded and there's not a lot of interest in that company, should think twice about it. Is there a lot of market sentiment on it? And where should you enter the stock, and where should you exit the stock or take profits in the stock? Learn technical analysis. Once again, you can go on websites like Investopedia.com and even use ChatGPT to help you understand what are the basics of fundamental analysis that I should learn. What are the basics of technical analysis that I should learn? So really good individual stock investors combine both types of analysis. First, they find a really good company to purchase, and whose stock they want to own, to be a part owner of that company. Because when you buy a company stock, you're a part owner. And then when should I buy that stock? And at what point do I see it topping out to where I might want to take some profits out of it and get my basis, or what I put into it, out, pay some taxes on it if necessary, and play with the house's money after that. So there are internal and external market forces that will push your stock price around that really have nothing to do with the fundamentals of the company. So key factors in external forces our Federal Reserve policy. When they raise or lower interest rates, it has a huge impact on the market. And there are, wars, market cycles, etc. So understand this: secular bull markets show long-term growth. Cyclical bull markets are shorter and more volatile. And you need to know if you're currently investing in a secular bull market or a cyclical bull market. Now, you're probably wondering what bull and bear mean. If you're not familiar where those names came from, it's the way the animal attacks. A bear reaches up on its hind legs and attacks downward. And that's why stocks go down in a bear market. That's why they call it a bear market. A bull market has a bull, has horns. He gets his chin on the dirt, and he attacks upward with his horns, and that's why the market goes up. And because they call that a bull market. So there's a little tidbit for you. You can use that at the next dinner party you're at. Do you know why they call it a bear market and a bull market? So. But understand market forces and what's going on in the markets and what's making the markets go up and down is really important. And it'll keep you from making stupid decisions in buying or selling when you understand what's happening with the Federal Reserve. For instance, you've got to start watching the Federal Reserve if you're going to buy individual stocks. The Federal Reserve, when they raise rates or lower rates, it can really make the stock market move. Basically, the bond market, which is the Federal Reserve, is determining how much loan rates will be on mortgages and what banks can borrow from the Fed and from one another. And and the bond market is 20, 30 times larger than the stock market. So the biggest elephant in the room moves the herd. So you've got to stay up with it. I'll tell you this, most financial advisors never tell you to watch Mad Money by Jim Cramer on CNBC, but I record it every night and I watch it. Uh, I watch the first 5 minutes and then I usually watch the last 2 or 3 minutes. It's a commentary on something else that's usually interesting from Jim. Jim's very entertaining. You'll want to watch the whole thing, and you can if you like. But I just record it so I can watch the first 5 minutes. That's a market recap usually. It tells you what happened in the markets today and why they went up or down, and what dragged them up, what dragged them sideways, what dragged them down, and what's going on. It's very, very educational. I started watching him daily 5 years ago, and it's something that I watch every night after the broadcast is concluded, and I watch the first 5 minutes, and then I zoom through the rest of it to the last 2 or 3 minutes. If I see something I'm currently invested in that he's talking about, when I'm fast forwarding, I stop and I watch that, but then I go through. So many of the things that he talks with callers about investing in are screened out of my world because his investors don't seem to care. That call in don't seem to care about environmental factors much or moral factors much. So I use that quite a bit. So there, I've mentioned this before. If you take gains, maybe what you put into it, you bought $200 worth of stocks worth $1,000 now, and you decide to take your $200 out and play with the house money. Um, you're going to have to pay short or long-term cap gains taxes on that. So start studying capital gains tax rates. And if you hold a stock for more than a year, you'll pay 15% on gains in the stock. If you hold it less than a year, you're going to pay ordinary income tax. So you make pretty good money at your job, you might pay 20, 22, 24% on the gains in that stock sale if you sell it within inside a year. So, however, if you're doing this kind of individual stock purchase in an IRA or a Roth IRA, you won't have any tax liabilities now. In the case of an IRA, you pay taxes on everything that comes out of it. On a Roth, you never pay taxes on it. You've already paid taxes on what went in. I like buying individual stocks in a Roth IRA because I know I can buy them and sell them and not have to worry about tax impacts. And if they skyrocket, I won't have to pay taxes on the way out. So strategic planning is really important, and be tax efficient in your purchases. I had a friend who made a lot of money one year day trading, which I don't like because he'd make any money the next year and he lost it all. But he ended up paying so much capital gains, short-term capital gains tax, is he was a high earner, and he ended up paying 30% on all of his gains that year. And the next year, of course, he tanked, but not after he paid the government a lot of money. So don't be like him. Align your goals with taxation in mind. If you don't want to pay the tax, hold it, and just reinvest dividends. You have to pay tax on dividends if you're buying a stock that gives you a dividend, but that's not usually a ton of money. But learn tax code before you start investing in individual stocks, and know what kind of account you're investing it in and what the tax implications are of you getting started with this. So, final advice. Closing thoughts. Investing should really be done with caution and understand your own personal limitations. Be patient with yourself. Don't start with a large portion of your retirement savings. You could lose a lot of money and really screw up your financial future. So don't invest in individual stocks early on, especially with money you can't afford to lose, because you're going to make mistakes. Learning comes through mistakes in investing. So if you can't afford to make a mistake, maybe this isn't for you. You've got a very strong stomach with it. Don't get overconfident. And I have this underlined here on the slides. Don't confuse brains for a bull market. In a bull market, rising tide lifts all boats. And in a bull market, when everything's going up, you think, I made a lot of money on that. I'm wonderful. I know how to pick stocks perfectly. And I was like, no, you could have thrown a dart at a board and everything would have gone up. You're not smart. It's just a bull market. So learn and be humble. And you don't know it all. You may never know it all. So and when you hit a bear market, if you're really smart, you're going to stay invested because it will eventually turn around. Might take 12, 18, 24 months, but it will turn around. If you bought with conviction, hold with conviction during a bad time. So remember, most investors have a greed and fear cycle. They're greedy at the top and fearful at the bottom. And there's nothing really wrong with that, but you just need to be fearful of heights and greedy at the bottom, and then you'll be fine. So just continuously learn. So I want you to keep learning. Don't stop learning. And ask questions. And remember this, you don't know what you don't know. So I hope this has been helpful to you. And I want to encourage you to do your homework and and this was designed to teach you how to fish, not hand you a fish, because I really want you to grow and learn on your own. So have a great day.